Hello, folks. Welcome to the Two Stewards Show. My name's Mark. I'm here with Brent.
Hi, Mark.
How are you today, Brent?
Yeah, I'm doing pretty good.
Good. Good to see you. Second time in a week.
Yeah, I know. You got to stop forgetting to push record.
I think I pushed all the buttons today,
So
we're good. But today, we really hope we don't forget the audio because we got a guest here, and his name is Adam Niman. How are you, Adam?
Nyman. Close enough.
Nyman.
Oh, I'm sorry.
Everyone does it. No, it's fine.
Nyman. Okay, Adam Nyman. And Adam, well, what are you actually, Adam? I'm not gonna,
Financial advisor, I guess you could say.
Advisor. Okay, yeah.
I don't know what I am anymore, to be honest.
But we, so we kind of got introduced to you through Rockstar, as many of our guests, and you wrote a book a while ago. And
it's a little generous calling I wrote a book, but yeah, I guess.
It's because I also wrote a book that's like this thick, so I call it writing a book.
Fair enough. I'll make the pages smaller so it gets thicker. That's my plan for version 2.
Okay, well, you have a guideline anyways, right?
Yeah, totally.
Talking about infinite banking. So this is...
The other side of the coin.
Yes.
Yeah.
Yeah, okay. So we've got Nelson Nash here. I'll hold that up for the camera. Right, becoming your own banker. And so this is the idea that you can use insurance policies to essentially be your own bank. You pay yourself out, and it's
A specific
sort of like
type of one, not just any insurance policy, but dividend-paying whole life insurance called participating life insurance.
Yes.
Those ones, yeah.
Yeah, exactly. So, okay, listen, college boy.
I don't know.
We'll get into it. But just the idea that you can use an insurance product, because, I always thought insurance is, if something goes wrong, then you've got a backup plan, right? But then somebody figured out, hey, we can use this life insurance product and use it actually as an investment product. And that became kind of popular more among wealthier people, right? Because the premiums are typically higher. But anyways, you don't like it. And I don't like it either, but you've got a much better way of explaining it. So can you maybe just explain first the concept of infinite banking?
Yeah, totally. So the concept is, I'm going to talk about the hardcore infinite bankers, because depending on the individual you speak with in the context of looking into these products, the philosophy and the pitch is a little bit different. But the R. Nelson Nash pitch that we hear a lot about, that I probably think is the most prolific one, talks about borrowing specifically. And that when you borrow from a bank, whether it's CIBC or you're getting a car loan and you're borrowing from Honda, or you're getting a tractor for your farm and you're borrowing from John Deere, whatever it is whenever you're borrowing from someone else, that interest is leaving you and they gain the benefit from it, whoever they are, whether it's the bank or the financing company. And the problem with that interest leaving you is that that's gone forever. That's money that you'll never be able to benefit from again. So wouldn't it be great if you could borrow and effectively regain the interest that you are losing throughout your lifetime? And who wouldn't appeal? Of course, sense. That's amazing. Do you want to borrow from yourself? Yes. Is it better than borrowing from someone else? Yes. It's a really interesting pitch, an interesting concept.
Well, if you think about the total amount of interest in someone's life, they're borrowing for their house, their tractor, their car, or whatever, and then add it all up over your lifetime.
Totally. And you could also argue that unless you are mortgage free, every dollar that you spend is effectively borrowed money. Like you may be in a positive equity position from you may be in
blank looks.
You may be in a positive equity position, right? Yeah. But you're still on a margin, right? And just because the money hits your checking account and then goes out, right? The debt is accruing somewhere else. So whether it goes in your checking account and you pay it out, or it goes into that credit that you pay down and you pull it back out, you're always borrowing from someone. Yeah. But the government's always borrowing from someone. Everyone's constantly in debt. So it appeals to people. Right? Yeah, debt does make the world go round. It's all about liquidity and credit, right? Yeah. So the idea is that because you constantly need to borrow from someone for everything you buy in your life, namely the larger items, it's better to borrow from yourself. And the best way to borrow from yourself is to use a system of participating whole life insurance policies. And by borrowing from a dividend paying participating whole life insurance policy, you are effectively borrowing from yourself because you are an equity holder in the insurance company. You are a part owner in the insurance company. So why pay interest to CIBC or John Deere or Honda or whoever it is? You're not an equity holder in that, but you should be an equity holder in this participating insurance policy. And by you paying interest into the insurance company, that interest is flowing back to you in the form of a dividend. And over the long run, your net worth will be a lot higher and you'll regain all that lost interest and you'll leave more money to your family, more money to your kids. You're going to be a higher net worth. Wealthy people do it. The Rothschilds started some business by borrowing from their insurance policy, which may or may not be true. I don't know. But that is effectively the pitch. Don't borrow from them, borrow from yourself. The way to borrow from yourself is through a system of insurance policies, one or many, and it's not a product. It's a process. Focus on the process, not the product. And by focusing on the process, you regain all that interest that would normally lose you. That's effectively the concept.
Okay, so then, like, practically, how does that work? I buy a whole life policy, and I put in, I mean, these are typically higher premiums, right? But if it's like an investment thing, that's fine because I'm investing in my future or whatever.
Well, it's interesting you mentioned that typically higher premiums. You could spend $5 a month on a policy. You could spend $50,000 a month, $500,000 a month on a policy. What's interesting about infinite banking is that there needs to be enough money in there to justify the borrowing. Like if I'm pitching to you and I know you're wealthy and I think I have an opportunity to sell this to you and you need to finance, let's say you're a farmer and you need to finance tractors. I'm not going to show you something $100 a month because it's not going to accumulate thousands to justify borrowing it back, levering it for a tractor that, listen, I'm going to get skewered. I don't know how much tractors cost. Let's call it, $50,000. I don't know.
That's a little tractor.
Okay, there you go. There you go. Maybe you need to live. But there's a lot of people I sit down with and they'll say to me, oh, well, the minimum premium I was shown was $25,000.
Yeah.
Right. And they showed me 25, 50, 100 and 200,000 a year. And they do, and so like I didn't know what to do, and I didn't understand it. It didn't make sense, so I just went with the smallest one of 25,000. And I'm like, geez, I need to increase my quotes here. But that's effectively, you can effectively put whatever you want into it. Think about a line of credit that you get from a bank. You could, assuming you qualify for it, you can make it as big or as small as you'd like. It just depends on how much liquidity and credit that you need. But you can put in $100 a month. You can put in, listen, the biggest sale in Canada last year, I think, was a $6 million a year premium.
Wow.
$500,000 a month, I think, was through Sun Life, if memory serves me correct. So, big money.
Yeah. So I put this money in, and then I can start borrowing whatever cash value has accumulated
immediately.
Oh, immediately.
Yeah, you can, depending on the setup. Obviously, if you're putting in $1,200 in your first year, most you can probably borrow back is maybe $1,000.
I just want to simplify this to back up. Like, why is it an insurance product in the first place that offers this sort of thing, right? Like, and maybe just for people who might not be familiar with life insurance, like what different types of life insurance, like why is there a specific type of life insurance this works with, or like doesn't work with, or whatever? And
so let's start there. Two types of products in general: term and permanent. Term, 10, 20, 30, 40 years. You can do 15, 25. There's insurance companies now. You can effectively go on and click how many years you want, 11, 12, 13. It doesn't. But at the end of the day, it's only really valuable for that specific period of time. It renews automatically and
like
expires.
If you die in this period of time,
it's a big payout.
The payout.
Exactly. And at the end of that, the money's gone. Right. There was.
So you have to get a new policy.
Yeah. If you need one, I don't know, maybe you got all this money, you don't need insurance anymore. Yeah. But at the end of the day, if you don't die within, a good example is I have a 20-year policy for $6 million that's costing me $320 a month. Yeah. I got it at 35, 36. So if I don't die by the time I'm 55, it's money down the drain. And to a lot of people, they'll be like,
are you married, Adam?
Yes.
Does your wife know about this?
Yeah, totally. Well, listen, two things. A, I'm an aggressive investor, right? And I do private lending. and there's money in a lot of different places. And if something happens to me, I don't want just take the money. The rest of it will trickle in, maybe never. I don't know.
Yeah, okay.
And I have some money from my brother and money from my dad. Like, they help me, and we're a family, right? So you want to support the ones that support you. A good steward, you know?
Yeah, there you go.
Yeah.
But if I don't die by the time I'm 55, knock on wood, right? It's gone. It's money down the drain.
Yeah.
Yeah.
So, well, that's a waste. Statistically speaking, the vast majority of people I meet with aren't going to die in their 50s or young, right? That's just how the world works. So wouldn't it be great to have something that stays for your entire life? So that same $6 million policy, I don't know, would be costing me $3,000-$4,000 a month. And that's permanent insurance. So rather than it expiring at a certain date or being gone, it's guaranteed to pay out at death, whether the death happens, you know, God forbid, right after you sign the contract or at the age of 100. You keep paying it for your entire life.
What if you stop paying?
Well, so that's interesting. There's contracts where they give you a guaranteed payment period for 20 years, or some contracts where you're effectively prepaying it. It's like you have a mortgage that's amortized over 30 years. Well, increase the payments and you can pay it off in 20 years.
Right.
Or you can do a line of credit and never pay it off and just carry the interest. And that's what I prefer, because I think my capital's more valuable elsewhere. That's a judgment call, a philosophy call, an education call in terms of what you believe in money and what you want it to do for you. But effectively, whether you're prepaying it or stretching it out over your lifetime, there is a fundamental cost to that protection over the course of your life. Two types of permanent insurance policies. Those that you just pay the minimum. So if I want myself to be covered for $1 million for the rest of my life, it's going to be $500 a month. And that $500 a month is going to be $500 a month, whether I'm 100 or whether I'm 30. And then when I pass away, the $1 million goes to my family. The second type is, well, instead of putting $1,000 a month into that contract, which is just the bare bones cost of the protection, what if I put in $1,100 a month? That additional $100 a month will grow tax-free and accumulate tax-free. Now, the nice part about that is that $100 a month can be used to pay premiums in the future. That $100 a month is usually invested in something, and that's where you get the separation between universal life and participating whole life. With universal life, you take that $100 a month and you sit down with your advisor, and here's a list of funds, you know, guaranteed interest accounts, managed funds. You've sat down with a bank, you've seen their list of fund options, portfolios, indexes, specialty funds. Usually the funds inside insurance policies are more conventional, I'd say. There's nothing too aggressive because it's supposed to be a more secure investment. But at the end of the day, you can move the money around. You can say, oh, I believe the US is going to go on a bull run because of Trump. I want to go all in on equities in the United States. Or I think global equities are going to rebound, so I'm going to go there. Or I don't know what the hell I'm doing. I'm a long-term investor. I'm going to take a global balanced portfolio, get a little bit of everything and figure it out. But at the end of the day, you can move the money around whenever you want, decide to increase or decrease deposits as you like.
And the money you're talking about here is the premium, or the percentage that you're paying over and above the cost of the insurance. Okay.
Exactly. And that grows tax-free. Participating whole life, they effectively lump the cost of the insurance and the additional investment component together into one amount, and they effectively invest it for you. There's no choice. At the end of every year, they pay you a dividend. A lot of people think it's based on the returns of the underlying fund. That's not the case. But nonetheless, they invest it for you. You decide for yourself. That's the distinction there.
Yeah, and then they make the spread.
It's more complicated than that, but yeah, that's the idea, right? And here's the thing, like permanent insurance can be a good product for a few reasons. I think the first reason is a lot of people these days, especially real estate investors, for their entire life, they're going to be asset rich and a little bit cash poor. So when you pass away, when you don't need the term insurance anymore because the kids are grown up or the mortgage are significantly lower, it's nice to have that few $100,000 of liquidity come to your wife or your kids just to deal with things over the short term. You know, cash is king. Now, I know for a fact that my permanent policy, over the course of my lifetime, I'm going to pay a lot more in premiums than that $250,000 is worth. But the cost of my insurance is only $167 a month. The majority of my wealth, I'm not dumping into this insurance policy. It serves a purpose, liquidity. The second thing is taxes. You have real estate, buildings, assets, businesses. you want those assets to remain in the family. You know, you want to be able to pay that tax bill when you pass away. You get insurance for that purpose. You're effectively prepaying it. The key is with that structure is that no one's like going to work in their 80s to be like, that premium's $5,000 a month. I need to keep that going to pay the tax bill. Usually it's the assets that are fueling it. So you have families with a few buildings. A portion of that net income is going to finance these products so the kids don't have to take on debt, pay the tax into the next generation. So no one's like working hard for that premium. And the last reason is when you do have wealth, sometimes people have a lot of money, they're done investing. Their money is making more for them than their ability to spend it. You have, I don't know, a $50 million portfolio. It's making 5% a year. I would argue that that doesn't beat inflation, true inflation, but I'm not spending $2.5 million a year. I don't care to buy another, I caught myself. I don't care to buy another property. I don't care to put it in the markets. I also believe that inflation is actually a lot higher than what they're telling us, but I'm never going to spend all my money anyways. I just want to dump it into something where it's going to grow tax-free so I don't have to write these big checks to the government every year. And if in the long run it's just a GIC, that's fine. But I have so much money, I'm just going to sink it into this. And there is a solution here. You can save on tax. In the long run, when you think about it, interest income is taxed at a top rate. So if you have millions of dollars in a GIC, you know, the returns every year, half of that is going to the CRA. So why not put it into a life insurance policy? You know, if I die in the short term, it's a massive windfall relative to the premium. And based on the conservative illustration, if I died 100, it's like 4% internal rate of return on my money. Interest rates, you know, were 2%. So why not? It's a win-win. Like there is a place for these in these products for the wealthy. What infinite banking has done, it's taking these concepts that appeal to wealthy and twisted them to make them appeal to the lower middle income people in a significant way, a very significant way. So much so that you have people who I would argue definitely are on the right track, but are far from wealthy enough to justify the premiums that they're paying and are sadly working hard to make those premiums thinking it's an investment. And then people who sell this would be like, well, it's not an investment. It's a process. I'm like, okay, well, why are you putting all this into the process? You know, it's whenever something does everything for you, it can't do all of it really well.
Yeah.
You know, the person who won the decathlon, like if they could, they would run the 100 meters and win that. You know, like the person who they may be one of the best athletes in the world, but they're not the best at
everything.
And you can't be the best at everything because you're going to sacrifice in something else.
I would just like to be good at something.
I think you're good at something.
Okay, so I think you've sold me. Where do I get one of these infinite
$5,000 a month right here. Let's go. You know,
I don't have that. Okay, so but what's the drawback? I mean, it sounds pretty good, right? You put in. Okay, I'm putting a bunch in, but let's say I have that money. I'm not wealthy, but I've got some money to spend. I'm going to invest it, and then later on, I can borrow that money back and reinvest it in something else, and like I'm getting twice as much money, right?
Well, so numbers matter, right? You know, you can say all these stories all you want, but I do a lot of private lending, and I was financing a guy who was taking on a lot of private debt to grow his portfolio. And when things were going well, it was going well up until the market rates rise and the market turned. At a high level, you can say to someone that what you do is you buy a house, BRR, right? You renovate, you refinance, you keep going, you don't stop. And you build this massive portfolio. But what if you heard a friend was doing this and he was doing this with 12% money? You'd be like, man, you be careful, slow down, because you're giving yourself no flexibility here. What if you knew that every single property he had was cash flow negative, but he was constantly using the equity to fuel the next phase?
Sounds like the government.
Well, yeah, the government can just print more, right? But if your buddy was doing that, you'd be like, man, be careful. Like if things are going well, sell off one of these properties, rebalance, get cheaper debt, because the first sign of danger, this whole thing comes crumbling down. So numbers matter. You can say philosophically that it makes sense to do something, but you have to attach numbers to it to really justify it. So in the context of infinite banking, you're right, it does grow. You can borrow against it. But what if I told you you're leaving millions and millions and millions on the table by doing this? If you have $5,000 a month to spend on something,
Yep.
and you put, I'm working with a gentleman right now as a doctor. He was pitched a product to put $100,000 into over the next 10 years. And then he stops paying for it. The
So
dividends,
it's $1 million.
$1 million over a decade, and then he stops paying for it, and the dividends pay for it for the rest of his life. And you can borrow against it to invest, and he trades actually with the leverage. So he borrows up to 80-90% of the cash value every year, trades that in options. He's doing well with it. And then at the age of basically 100, the death benefit would be around $4 million, assuming there was no debt, right? Well, I ran a calculation. If you just put that same money in the index, you put 100 grand in a year for the next 10 years, you let it sit, and then you don't put anything else in, at the age of 100, you'd have $45 million. Like, that's what you're leaving on the table. That's the trade-off. And this is why banks and insurance companies make a lot of money, because they take our money, right? They give us pennies on the dollar, and they buy assets, and they make the difference. So let's say that same person had $50,000 a month that they were investing because they were wealthy. Put $5,000 a month into this. 100%. You get some leverage, you get some life insurance, you can use it for tax savings. You're going to have some taxes at your estate. Your kids will need some liquidity, right? You want to have some life insurance because what's $5,000 a month in the context of your 50? But you're going to put the 50 into the 45 into traditional investments. The hardcore infinite bankers of the world will tell you, no, put the 50 a month into this and then borrow it back to fuel your financial future.
Yeah.
And that's my issue, right? These products should be looked at as the cash component of a portfolio, not as the basis of a portfolio. But when you tell people that when you borrow from this, you're making the interest, people are like, well, hold on a second. If I'm making the interest, of course I should put my $50,000 a month, all of it into it, because like, I don't want the bank to make my interest. I want to make the interest. So I'll put all my money into this. I'll borrow it back out. I'll use the borrowed money to grow my nest egg, grow my wealth. And this is amazing because in this book, it says you make what the banks make. Like, that just can't be true. A good example is, let's say your house is paid off with $1 million. You go to CIBC. You say, CIBC, give me a line of credit to 50% for $500,000. Cool. You take that line of credit from CIBC and you go and you buy CIBC stock. I think two things can be true at the same time. A, that's actually maybe not that bad of an investment. You know, if you believe that banks in Canada have a run up over the next few years, they're paying, let's say, a 5% dividend. You're paying 6% on your debt. You know, the 1% spread is pretty cheap debt. You get to write off the interest, and then you get capital appreciation on that $500,000. That's not that bad. But you can't tell me that you're making what CIBC makes. You're not recapturing the interest that would normally like leave you go to CIBC and come back to you in the form of a dividend. You can't draw a straight line from the interest that you're paying CIBC to the dividends that you're getting. No financial advisor worth anything would sell that strategy as be your own banker. They wouldn't. They would be laughed out of the room. Ironically, when it comes to this stuff, people just take it as gospel.
But you're still making a spread, though, right?
So you think so. What's interesting about these products, participating life insurance, people will say, I'm getting 6% of my money. You know, so why not, when interest rates were low as an example, why not borrow at 3 or 4 and make 6? The problem is that the 6% is not an actual percentage. It's called a dividend scale interest rate. And this is a massive misconception in the product. The dividend scale interest rate represents the accuracy of predictions. So think about an insurance company and how they operate. They take in premium. Their expenses are obviously salaries and whatnot for the people managing the company. And the major one is death benefit. So they take in your money, they buy assets that grow over time. They have to have money in reserve to pay out the death benefit. And at the end of every year, based on the growth of the money, less the expenses and the death benefit, there's some money left over, and they give you that money in the form of a dividend. The problem is that you don't own units in the insurance company. You don't own units in the participating fund. Those dividends represent the accuracy of predictions. they don't at all disclose what those predictions are. And when they tell you you're getting 6% dividend scale interest rate, they make it seem like it's a percentage, because I don't know if you've sat down and seen these charts. Most insurance companies have them. They see dividend scale interest rate here, then S&P TSX, then GICs, then bonds, then the consumer price index. If the S&P TSX did 10% this year and I had $1,000 in it, I'm making $100. But if you put $1,000 into the par fund and the dividend scale interest rate is 6%, you're not making $60. But they make you think you are. It's like having Celsius and Fahrenheit on the same chart with numbers.
Yeah.
Right? You're not measuring the same thing. If you're calling something a percentage, it should be a percentage. If it's not a percentage, then don't call it a percentage. Right? So this is kind of where the misrepresentation starts. The dividend scale interest rate is heavily based on the interest rate environment. So historically, when these policies were sold, a lot of people thought they'd be very valuable in the future, but that was based on interest rates staying high. Interest rates came down. A lot of these policies are getting dividends which are a fraction of what was illustrated in the 70s, 80s, and 90s. And I started down this path when I started seeing all these old products not getting what was illustrated. And you started asking questions, you don't get good answers, and you start having a vision, you start kind of questioning everything that you're hearing in and around the industry.
So the dividend, I kind of got lost a little bit. Mark, are you following some of this stuff?
Sorry,
so
man,
dividends,
sorry.
Yeah, he had a full coffee. You're almost draining.
Yeah.
No, I've heard some of this before.
Well,
so.
okay. You said you were selling this stuff, or you got your license? Or?
No, not this stuff.
Okay, not this stuff.
Yeah. We'll get
But
back
the
to
dividend scale interest rate, what exactly is that referring to? Like,
So
exactly. I think that's the whole point. What is it?
Yeah.
It basically refers to the accuracy of a set of predictions.
Okay.
Right? So the insurance company is basically saying internally, we believe over the next 10, 20, 30, 40, 50 years, stock market will do this, bond market will do this, mortality will be this, our expenses will be this.
Yeah.
And based on those numbers, we think in year 23, 24, we can afford to pay you an X $1,000 dividend based on the premiums that you're paying.
Yeah.
So so when you have this, let's say a 6% dividend scale interest rate, that's 6% of sort of their prediction, maybe.
No, I don't know what I honestly don't know what it is.
It's a percentage of their prediction, but it's not 6% of your $1,000 a month.
I don't know.
Whatever.
It could be 6% of their prediction. I don't know. I honestly don't know what it is. I found in an old 1994 participating policy, there was a page in the back of one of my clients' products that I met that had their 1994 Manulife's dividend calculation, and it was effectively a massive calculus formula.
Yeah.
Like I don't understand it.
So yeah.
And the point is nobody really does, except for the insurance company.
Exactly.
So, I just want to be clear. Like what you're saying is, we got a 6%. If I was looking at it and you showed me, here's GICs, here's the S&P, and here's the dividend, I wouldn't look at dividend scale interest. I would just look at dividend. Oh, 6%. Okay, so $1,000, 6%. Perfect. That's as far as I would look. But what you're saying is no, it's 6% of something.
I don't know. I don't know what it is.
But only the insurance company knows what that is.
Mm-hmm.
And to date, nobody has ever disclosed that, because it's proprietary, right?
Yeah, and all the insurance companies have their own method here. And the infinite banker's argument is, well, borrow from the participating fund because you're an equity holder in the fund. I'm like, well, it's interesting. Now it's an investment. If you're an equity holder, I thought it was an investment. But if you are an equity holder in the fund, why can't you tell me how much equity I have? My kids have Equitable Life par policies that I bought ages ago. I get a dividend every year. It's just a number on a piece of paper. If you got a dividend from CIBC, you would know exactly where it came from. You'd be like, okay, I have 1,000 shares. They're issuing a dividend of 50 cents a share, $500.
Yeah.
But when I get a dividend from Equitable Life, it's just like this year you're getting $649. And the more I went down this path, I'm like why and where?
That's more than 500, though.
Yeah, there you go, exactly. But if you don't know where the money's coming from, how it's being calculated, then you can't tell me I'm an equity holder. You're not. I don't know what I am. I'm some sort of unit holder, but I don't know how many units that I have. And it's okay if you bought this as a tiny long-term investment insurance policy. But if you're putting a lot of money into it that isn't justified. And it's being sold to you as an investment, which most people I meet are. It's problematic.
So is your assumption that, or your conclusion that this life insurance stuff, becoming your own banker, is obscure for a reason and misleading, and like you're selling these products as well, right? But
I don't sell this anymore. I don't sell PAR anymore.
Okay. So maybe you can talk to that a little bit. Like what do you do in this space, and like what is your angle towards this? Because I think, I don't know, there seems to be some contention in this industry. I don't know.
Yeah, I know what you mean. So
we're probably going to get some hate mail on this.
Yeah, let's do it. You know, redirect it to my office. It's really hard to talk to people about life insurance because it's not a sexy thing to talk about.
Yeah, you're going to die.
Exactly. And listen, generally speaking, it's an awful conversation. So isn't it great to talk about and sell life insurance without having to talk about and sell life insurance? That's what makes this so appealing. You know, the whole sizzle and steak. Don't sell what it is, sell what it does for you. And with a concept like this, it allows people like me to sell large insurance policies, check all these boxes: leverage, growth, investing, taxes, death benefit, without having to be like, you're underinsured. What is your wife, kids, father, mother going to do? But effectively what I do is I started marketing being against it because I realized how many people were putting so much money into these things. They didn't realize how much money they were leaving on the table. And what I'm realizing through my marketing and through meeting the people I'm meeting is that the advisors who are selling this extensively are looking at every client through the lens of this product. So they meet you, they look at your finances, and they say, how can this product complement what you're doing? Or how does it enhance what you're doing? When someone comes to me, I'm like, what are you doing?
Yeah.
And based on what I know of the industry, do I have products that I feel like will protect you or will move the needle for you if something were to happen? That's the way I think about it. I try to look at your situation and what you want, not come in with, I have this product I want to sell. How do I position this in the context of what you're doing? I look at your situation and say, if you have all this debt, if you don't have a lot of money, and you don't have investments, like why are you putting thousands a month into this? And I see that all the time. I see a lot of people who are like, oh, I was told to collapse my stock portfolio and put into this. Oh, I was told to refinance my house and put it into this because it's going to be great investment over time. Oh, I was told they've paid out a dividend every year for the last 110 years. I'm like, well, that's not entirely true. And it's just being oversold. People don't realize how much money that they're leaving on the table in the long run by simply not putting money in the index, in real estate, in Bitcoin as a great example, actual long-term assets. Because I tell you, that's what the insurance companies are doing. They're taking your money and they're buying real assets with it. If you want to be your own bank, take your money and buy real assets.
Okay, so I have a couple of questions for you. Number one, how many insurance companies have gone bankrupt in North America?
I don't know.
Okay.
I
think the number's like got to be close to zero. You know, like how many have ever not paid a dividend?
So,
or how many have not made money? I think that's my point.
Well, they all always make money, right? As an investor, it's not a question of do or do they not make money. It's a question of how much money do they make and how much of that money do they issue to shareholders. I don't know a lot of how many companies have or haven't gone bankrupt. I do know that in Canada, rather than companies in the past going bankrupt, they've just been eaten up by some of the larger insurers.
Yeah.
And I do know that there are companies that had these products that oversold them and had too rosy of predictions. It squeezed them financially and they had to get eaten up by some of the bigger ones. But generally speaking, I think it happened more in the US just because a little bit more of cowboys down there, less regulated, more banks, more insurance companies. So it's harder to regulate. But in Canada, like I'm really not sure.
Well, so I guess my point was more like, don't bet against insurance companies, right? Warren Buffett is in insurance for a reason, right? Because like it makes money. It always makes money. Mm-hmm. It's like betting against the house, right? The house always wins.
Yeah, but there aren't many places that you can park billions of dollars. and confident, like scale and size matters.
Yeah.
You know,
that's true.
It's, if you have billions of dollars, go invest in Manulife, take that little dividend. You're not going to get a lot of growth, but you know your money will be safe. When you have that much money, like, safety and lack of volatility is a priority. But for the vast majority of us who don't, you know, volatility and risk is your friend. Not risk of going to zero, of course, right? That's speculation. That's going to the casino.
Yeah.
You know, I've done that too, and it can be great, and it can also destroy you. But when I say risk, you know, things that are going to be there 30 or 40 years from now, but you know they're extremely volatile. But, you know, that's how you make money. You know, the people have billions of dollars. They don't have it because they invested in Manulife or invested in participating life insurance. They took a risk, they started a business, they speculated on something, and they made the billions or millions. And when they did, they secured it. They didn't have the money in the first place and decided to put it into these products.
Yeah, it's always opportunity rather than sort of slow and steady.
Right.
Okay, next question. What do you get paid on on a $1 million term policy? And this is generalization versus $1 million whole life policy.
That's a good example. So I do a lot of joint $1 million policies to people in the 30s, right? You're effectively looking at $100 a month for someone, husband and wife in their mid 30s for 20 years. I'll make effectively, you know, $1,300, $1,400 on that, you know, just over the first year's premium based on my bonus level. So no matter what, I'm making effectively the first year's premium.
Okay.
Right. So whether it's $100 a month or $1,000 a month, you know, $1,000 a month, I'm making 15 grand, right? That's why it's great to sell these big policies. Now, sometimes when you sell them, they're like overfunded. So you have, with UL, you're paying the cost of the insurance plus an investment. With PAR, the cost of the insurance is double that because they factor the investment component into the same premium. You can put extra money in as well above and beyond that. But generally speaking, advisors or the advisor network, whether whoever is above you, there's sometimes a few people above you, but generally speaking, advisors are paid, let's say, 130, 140% of the first year's premium, and then a little trickle thereafter. So it's significant.
So there's trailing fees as well.
Yeah, but it's like a couple of percentage points. It's not a lot. But hell, if you're selling, you know, 5,000, 3,000 a month policies every week, that pool can build up significantly.
Yeah, absolutely. So, I mean, yeah, like you were talking about, people are selling kind of what they have. Like when you have a hammer, everything's a nail.
There you go. That's
right?
exactly
like
it.
That's, so yeah, if you're selling this kind of...
And if you go to Home Depot and you ask someone, you say, I need 20 hammers. There's a lot of people going to be like, yeah, I'll give you 20 hammers. You know, I'll sell you that. I get a nice commission on the hammers. You want to find the person that's like, are you sure you need 20 hammers? Like, that's the type of people that you want to deal with.
Yeah.
You know,
Yeah.
I see a lot of people selling this. They're like, you don't want one policy. You need a system of policies. You want a policy on your wife, your 3 kids, your grandfather, your next door neighbor, right? And I'm just like, man, like if it's for everybody, it's for nobody. You know, you want to sit down with someone, especially financially, and say, this is what I'm doing. And you want the first question to be, well, why? Like, what's your thought process here? What are your goals? And I don't mean to say, like, it's hard in the context of goals with money, because everyone just wants more, right? Like, you really just want more in general, the right way. And I'm really not here to tell people what to invest in. You know, it's a hard thing to do because I like to take risks. I'm just more here to explain to people the implication of their actions and what they're leaving on the table by putting all this capital into the stuff. And I'm telling you right now, the people that I meet that are putting their money into this stuff, if it wasn't for the pitch, they would never have bought it. If it wasn't for these concepts that you initially don't attach numbers to, they would never have put thousands of dollars a month into it. If you say to someone, I have an investment where you can grow your insurance policy tax-free and lever it out, right, at a little bit better than prime, and when you lever it out, you can write off the interest and you still have some life insurance in the long run, you'd be like, yeah, that's cool. You know, let's look at some numbers and I'll sit down with you and I really have to look at the numbers, right? That would be most people. But if you say to someone, all that interest that's leaving you, you can recapture it, right? You're being poor because you're not an equity holder in the insurance company. The wealthy, did you know the Rothschilds, they did this to start a business? All these wealthy people are doing it. You'd be like, oh, wow, like they must be seeing something that I'm not, right? If they're doing it, like I should copy what they're doing, right? That's why it's so powerful, because you go from $100 a month permanent insurance sale to $1,000 a month infinite banking sale, and rather than making $1,400, you're making $15,000. How many policies do I need to sell a month to put food on the table, selling basic insurance? Whereas I can do maybe 3 or 4 of these a year.
Yeah.
And be pretty good. Or ideally do one of them a week or one of them a month. And think about it. Think of inflation. Everything's so expensive. So people who do what I do, they are chasing a way to increase their income. It's hard to sell, 10 100 a month policies in a month.
Yeah.
If I could sell one 1,000 a month policy in a month, it's worth my time. The problem is everyone who I see putting that $1,000 a month into the policy have, in my opinion, no business doing it at all.
Yeah. I mean, if you sell enough of those policies, then you could afford one of your own, right?
There you go.
Oh, man.
Interesting. So yeah, do the numbers and or look at the numbers.
Yeah. There was a podcast I was watching recently with a very popular gentleman who sells this. And he said, it was talking about how powerful the process is, not the product. And he's saying, this year alone, he was saying, like, guess how much money I'm making in dividends. And the guy was like, I'm not sure. And he's like, $85,000 a month. And he expected the other gentleman on it to be like, oh my God, that's amazing. But anyone who understands numbers would be like, well, okay, fine, you're making $85,000 a month. Well, what was your initial investment? What did it grow to? If you have $1 million invested, that's incredible. If you have $1 billion invested, that's absolutely awful. But there's all these abstract things that people, it's great to say this number, but you got to dig in further and know where it comes from. The money that they're giving you back is your own money. And they're making these predictions 20, 30, 40, 50 years out. I've been doing this long enough, 15 years. No predictions have been accurate. Like every day I'm scrolling through Facebook and the next day the world's supposed to end. There's supposed to be a crash. Everyone's always there's never been certainty. Every year I'm like, oh, there's more uncertainty. There's more uncertainty. This is all fodder that feeds the industry money. And I just don't believe it's a good thing. Focus on, buy term, invest the difference, I guess,
Yeah.
So
yeah.
what would be your stewardly approach? Because our kind of thing is to, part of the reason we want to have you on too is just to make people aware of what's out there, what to watch out for. Maybe they can read your book. What's your book called, by the way?
Fortune or Fiction.
Fortune.
I'm actually going to be rewriting a bunch of it.
Okay. So wait for the rewrite.
Yeah, sure. You don't have to.
It's on Amazon?
No.
No?
No.
Oh.
I should actually.
Yeah.
Yeah, I'm thinking of doing an addition to it, and then maybe I'll shorten it up to make it seem a little bit bigger, right?
Use big letters.
When people are dealing with someone, I think a few things. A, deal with someone who is in the same realm as you financially. Too many people in my industry are people with a little money chasing after people with a lot of money to make a lot of money. I think it's important to deal with people that are in your similar area of net worth. Like I was speaking to someone
just so that they can relate to you.
Yeah, 100%. It's 100%. Yeah. Like, if we're in the same level, what are you doing? What am I doing? And
because like you hear people say, oh, like you want to be associated with other people who are beyond you so that you can kind of pick up their habits or their ideas, or like.
Of course, but not too far beyond, right? Yeah. Fine. Like if I'm working with 4 properties that are worth $2 million, definitely sit down with someone and work with someone with twice the amount of property worth, $5 or $7 million.
Yeah.
But like maybe not with someone who owns like a billionaire.
Yeah.
Right? Because like I was speaking with someone the other day who was interested in this. And they were pitched a $200,000 a month policy.
Wow.
And I think the guy's worth like $100 million. And I said to him, I would love to sell you something like this. I genuinely would love it. I would want to work with you, but man, I can't relate to you. Like if I know what I would do with $200 million and like, I'm telling you, it's not this. And I just can't relate to you. It's too much money. with that amount of money, I'm done, right? I would probably put most of it in like basic private loans and like, I don't know. It's just, I can't relate to you. So I think for most people, relate financially to the individual that you're dealing with. Of course, you want to get advice from people beyond where you are, but in the context of like dealing with your current needs, especially in insurance, deal with someone who you feel like can really relate to your financial situation, who's invested in similar things philosophically. That's what I would think. That's what I would say.
So, okay. So what would be a good profile for most people then? Like you talked before about, you're paying this insurance and then when you're done, it's like you never get that money back. But I mean, we all pay car insurance at the very least, home insurance probably. And like, we're just, that's just in case. And we never get that money back. But if something happens, we're protected. So, I mean, would you say buy life insurance? Buy critical illness?
Yeah, like I sell 3 products. Like if you die, if you get sick, and if you get disabled, right? Ideally, everyone has have all 3. Sometimes it's just not feasible to do it.
Yeah.
But I think everybody who's young should get a big term 20 policy. Like, why not? It's so cheap. I was speaking to...
When you say young...
20s, 30s, young and healthy. No matter how old you are, it's always good to have a little bit.
Sorry, Mark.
It's not too late for me.
I was speaking to a young lady the other day. She has 4 kids. She's in her 30s. 20-year policy, $2 million was $70 a month.
Yeah, it's the cost of one avocado toast.
There you go.
Like that's like, it doesn't pay me a lot, but like that's the right thing to do. And she's like, what else should I do with my money? And I'm like, geez, like I don't know, like everything. I have a really hard time advising people onto like what to put their money in. My big belief is money is like kind of like a muscle, and it's very important that you work it. And what I tell to most people is start with the index. Put your money in the S&P. Every day when you're doom scrolling in the morning, I know you shouldn't do it, but you wake up in the morning and you look at your phone, right? The first thing you should do is open the stock app, get a feel for the news, and then when the market's open, once you've read the news, look at how the market is moving. And over a short period of time, you're going to start to realize, I'm like, okay, there's a rhythm here, right? It's unpredictable, but there's a rhythm here. And it's volatile, but it's really not that volatile. People are like, oh, like the market's risky. I'm like, yeah, there's a lot of different types of risk, but like if you put in 10 grand into the S&P, it's not gonna move that crazy every day. And then you're gonna start to see other companies pop up in the news app. And then you're gonna be like, oh, well, I buy a lot of Lulu, I like it. And oh, what's their stock price at? I understand Lulu, I buy it. If I'm buying Lulu products, might as well own the company, right? Might as well have some equity in it. The same idea.
Do you have their pants? You're not wearing them now, are you?
I am wearing them right now. I'm sorry.
Wow, I wish I hadn't looked.
Oh man, I love it. But and then over time, you're going to start getting comfortable with investing for yourself and doing it by yourself. And I think it's so important to do it early on and while you're young. You don't want to have this gap between you and your money because it's going to be with someone. Next thing you know, you'll be 65, 70. The world will have changed so much while you are making money, and you are going to be so uncomfortable in managing it by yourself.
Yeah, that's actually a really interesting point. I don't think anybody's brought that up on this show before. Like look, your money is a muscle and use it, develop it, flex it. And I think about the example of, buying a car, right? So if you're going to buy a car and you don't know much about cars, like you're going to go on Auto Trader, you're going to start looking at cars. You're going to read the specs of the car. You're going to, right away, okay. So that year, that color, that model, whatever sells for this price. And then you're going to, within a few months, you're going to know when a deal pops up. You're going to be like, this is the car that is actually good value. I should go see it, right?
100%. And the first time you probably are buying a car, it's like stressful and nervous. And you're like, you're speaking to everybody. You're getting advice.
Yeah.
But once you're 2 cars in, you're like, you're walking.
You have no money left, but you're ready to go.
Yeah.
And then the other thing I want to pick up on, you said, so like $70 a month, put it like, if that's the policy, that's kind of like the amount of money you have to invest sort of thing. Like there's almost tiers, right? Like you got $70 a month or a week or whatever versus like, a few thousand versus like 50,000. you can get into different investments, right? So
100%.
what do you think to that? What's your mindset around that?
Well, for the record, I disagree with Adam, and I think you should just buy Bitcoin. But carry on. Adam.
No, I agree. I think it's one of the best things ever.
Or you should have bought it.
You should. No. You gotta start small. Like, you have to accumulate from the beginning, but it's hard. Everyone's squeezed. You also have to understand like what the problem is, and I think the most important thing people need to do above and beyond understanding investing and just giving a shot on their own is understanding the problem with the financial system, the debt-based fiat system that we have, not to just go like dive right into Bitcoin. But a great example of the problem.
Disagree.
Sorry?
Disagree. Carry on.
A lot of the people who sell these products, specifically like the Nelson Nashers of the world, that like the problem with the financial system is that you're not in control of your money. The banks, someone else is in control of your money. Now, I would argue that anything in fiat, right, the system is always in control of your money, no matter what. People who do what I do say,
why do you say that though? Like what?
You need to send someone money, you have to go through a bank.
Yeah.
Like, unless you're using cash, right, which is still controlled and can be created by the central governments. When you're emailing, you have to log into your app to send someone money.
Yeah, like it's not your money. It's your money at the permission of someone else.
Exactly. If you are buying a house, you have to, even if you have it in cash, you still have to go to the bank. If you're borrowing it, it transfers to your lawyer. Like, we're in a controlled, not well controlled, but we're in a controlled system in that sense. If you sit down with advisors, they're going to say, well, the problem with money is that inflation is 2 or 3%. So you need to beat 2 or 3% to maintain your buying power over the long run. And that's what I'm here for you to do. I think the problem is that, actual inflation is a lot higher. It's the amount of money we print and put into the system relative to GDP. If that's what I think the problem is. The problem is you actually have to beat the print, which is 8%. And that's what the Rockstar community has, specifically Tom and Nick, has helped me realize more so over the last couple of years. Initially, when I wrote The Fortune of Fiction, I was thinking to myself, the reason why this is bad is because you could do better elsewhere. But that's kind of weird because you could always do better somewhere. Yeah. There's always a better investment. The reason why I want to change up the book a little bit, because I believe they're actually getting the problem wrong. Like, they're saying the problem is that someone else is in control of your money. They're trying to distract you from what the true problem is. The true problem is that the value of our money is being destroyed. That's the actual problem. And then we're all wealthier. We all have more money. No one feels wealthier because our money's being devalued on an average of an 8% clip. Anything you put your money into in the long run, it needs to beat 8% for you to just keep up. Understand investing, understand that number, and then deploy your capital accordingly. That's what I believe.
Yeah, and in accordance with your, I don't want to say your station in life, but yeah, like where you're at, right? If you're working a minimum wage job, your decisions are going to be a lot different than if you're like a doctor and you've got a lot more disposable income, for example. So. Okay, you mentioned before private lending. You do some private lending now.
Yeah, I've always done it.
Oh, you've always done it? Okay.
Not always, like last 7-8 years.
Yeah, okay. And this is like in real estate or?
Yeah.
Yeah, okay.
Yeah, so all real estate assets, yeah. Okay. I met through my selling life insurance, I met a gentleman who was a mortgage broker, and there was an opportunity to lend on a property, and it was actually in third position. There was a lot of equity in it. I knew the person in second position, and they said to me they wouldn't, if things went down, we could approach it together. And I trusted them. I made a lot of money on the deal. And I thought it was a great way to invest my credit. You borrow at 4, 5, 6, you're making 10, 11, 12, 13. And as long as you can make enough money to finance the debt when things go wrong, it's a nice way to make money, and it's a great way to find opportunities in the real estate market.
How do you assess risk? There's another podcast.
Oh, man.
Well, because you made the comment kind of offhand while you're going, like, I like to take risk, or I'm like, I'm risky or whatever. But how do you look at that? Like, I guess maybe it's a personal question, right?
Yeah. So how I now assess risk is I've 10x'd my money. I've lost my shirt. I've put money into a mortgage that has never paid and got my money out. I've put my money into a mortgage that has never paid that I lost money on. I've put my money into a mortgage that I've lost money on entirely. I've put my money into a mortgage where I bought the house. I got lucky with an appraisal and my mortgage turned into a down payment. I got into, Bitcoin early and did really well. I got into weed stocks really early, did extremely well. Thought I was smart and realized I was just lucky and I lost it all. The way I assess risk right now is how much attention does this investment need? How secure is it? And am I making enough to justify the downside? That's the way I see it right now. 5 years ago or so, I was very big on, flyers. You put a few $1,000s into these small things and one will 10x and one will go to zero, and that's fine because the one that 10x's justifies all the ones you lost on. But it gets to the point that it's very hard to track all those. Like it really is. And I didn't appreciate how much risk I was taking because of how easy money has been for effectively all of my entire career. Like I got into the industry effectively in 2009-10, right? When the money printer really started. And I've been taking risk effectively the entire time. And then only when things go south, you're effectively like trading up risk, thinking you're making money, when in reality, it's all on shaky ground. Now, you can argue that everything is actually on shaky ground, in the context of the financial system. But I'm more commenting on me personally. So these days, I try not to do small flyers into anything. I'm really big into like trying to my own real estate portfolio. So I have extra cash. I'll throw it into one of those facilities to pay down the debt and wait for a deal to deploy on. I still love private lending as long as it's like the right deal. I put money into the index because I believe in it. And I put money every week and month into Bitcoin because I believe in it. And anything that is not one of those, I just don't care for anymore.
And when you say you believe in it, is you've actually done the research and like you're not just I believe,
Yeah, like, totally.
You
Maybe
actually educated yourself.
Yeah, 100%. Well, the nice part about
I just want to make sure our listeners understand, just believe it and go.
No, exactly. No, it's not like I hope, right? Yeah. Actually, but the nice part about private lending, like you go to a house, right? You get an appraisal, you know what it's worth.
Yeah.
You know what it could rent for based on comparables. You figure out what the NOI would be if I could rent it out. You arrive at your own fair market value. You get a sense of how much it would cost to sell it, right? And do I want to park money there based on the return? And it's pretty easy. As long as you can stomach not getting paid at all. As long as you can stomach the fact that your money's effectively gone till it comes back, then it's a great thing to do. If it's hard for you to do that, then don't do it. But like anything with money, you have to start somewhere. You have to start small. You have to, whether it's the index or going into a fund. I'm a big believer in like getting dirty with your money, doing it yourself, understanding where the levers are.
Starting small, starting young, like you do have less risk.
100%.
Yeah, so
100%.
That's good.
Okay. So you also mentioned the critical illness disability insurance. I think you have a new product or a company around that, I guess, right?
Were you talking about the health spending stuff?
Yeah, sorry, health spending.
That's a whole nother kind of rabbit hole. But basically, I built a direct-to-consumer benefits platform.
Yep.
For businesses to offer benefits plans to their employee. So a lot of advisors who do what I do sell like the life, the health, critical illness, all that jazz, and they also sell group benefits. So if you're a company with 5 or even 500 employees, you want to give them benefits. You sit down with an advisor, they put together a package for you, and you sell that to them. Money's great because you're effectively making a percentage of what the premiums are, anywhere from 1 to 10%. Obviously, the smaller the company, the higher the percentage. If you sell a company with 1,000 people, you're not getting 10%, right? Economies of scale. But a lot of people don't realize that insurance companies are effectively making a percentage of everyone's medical expenses. Like if you need an insurance company because, if you die, they pay out the death benefit, or you get disabled, they pay out that monthly amount to your staff member. Or if your drugs are $1 million a year, they take care of that. Or if you're traveling and you get hurt, they'll take care of the hospital bill. But like, why do I need an insurance company to be in the middle of going to the dentist when you're getting glasses? Like, that's not a catastrophic thing. Like, why are insurance companies involved in that altogether? I'll have companies, small business owners reach out to me and be like, hey, I want benefits. And I'll be like, well, why? And be like, oh, well, because like
my friends have them.
My staff want benefits. And I'm like, but like, what do they need it for? And they'll be like, oh, well, they need to go to the dentist. And I'm like, well, are you preventing them from going to the dentist? Right? And they'll be like, what are you talking about?
Like,
and I'll be like, what are you talking about? Right? If they need to go to the dentist, help them go to the dentist. They're like, and they're just, it's, I enjoy having that conversation with people because they don't realize, no one really knows like what this stuff is. And all that it is a tax play. Like when you pay your employees, it's taxable. CPP, EI taxes are withheld at source.
Yeah.
When you pay your employees and you're reimbursing them for an eligible medical expense, it's a tax-free event. That's all that it is. You as a business owner, you get to write it off. Whether I write it off to you as a salary or write it off to you as a reimbursement of a medical expense, it's still tax deductible to you. But to the employee, they can get it tax-free or after tax. And if you're making if you have employees making 150 grand a year and you're bonusing them $2,000, they're losing $1,000 off the bat. But if you're giving them back $2,000 because they went to the dentist, doctor, physio, chiro, they're getting that full $2,000. So the reason is, my question, why do we use insurance companies for this stuff at all? Well, we use insurance companies for this because we use insurance companies for this. No one really thinks about it otherwise. These days, businesses are moving towards health spending accounts. So rather than giving your employees some big contract that says you can claim all this stuff, employers are giving their employees, $1,000 a year, $2,000 a year to spend on whatever they want. It's a much more honest and transparent way of going about it because the insurance companies create contracts that drive up the premium. I'll give you an example. Groceries are really expensive, right? You have staff, right? Would you like to help your staff with your groceries? Wouldn't that be nice? Of course it would. I'm going to give you a grocery store benefits plan. And here's how it's going to work. Each of your employees are going to get $250 a year at the bakery, $250 a year for produce, $250 a year for meats, and $250 a year for dairy, let's say. All for only $60 a month per employee. And you'd be like, most people are going to be like, hold on a second. Okay, how is it that I'm giving you $720 a year per employee, but you're giving them $1,000? I'd be like, well, the likelihood of each of them spending $1,000 is really low. Not to mention, let's say bread is $15. We're only going to reimburse them what's reasonable, what we believe reasonable bread costs are, which is maybe $12. And don't worry, we're going to guarantee these premiums for the next 2 years. And in 2 years from now, we'll sit down, and if they're spending too much, we'll just readjust your premium accordingly. You'd be like, forget it. It's like, don't worry about it. I'll just give them the $720 a year each. And then I don't have to worry about this. That's what benefits plans are. You're paying the insurance company $200 a month or $100 a month per person. And the insurance company is giving them a list of, here's these 12 paramedical practitioners. You can spend $500 a year each. That's $6,000 a year. Glasses, $350 a year. Prescriptions, $5,000 a year. Dental, $1,500 a year. And then you started out with a package that was
perceived value just grows and grows.
Exactly. So you start out with a package that's $2,000 a month, and then in 2 years from now, the broker comes back being like, "Hey, by the way, the $2,000 a month is going to $4,000 a month." You're like, "Well, I can't have that. Like, that's ridiculous." You're like, "Okay, I'm going to add a deductible here, add a co-insurance here, cut back on here, and we got the premium down to $3,000 a month. Is that comfortable?" You're like, "Oh, yes, it is." But you're not fixing the problem. The insurance companies are giving a booklet to your employees that are basically saying, go out and spend all this money, right? And then at the end of the year, they're being like, well, they're spending more money. Sorry, I have to collect more from you. It's a vicious cycle. The broker makes 10%. The insurance company in the long run wants to make 15%. Why are insurance companies effectively making a 25% trail off of everyone's medical expenses? That absolutely makes no sense at all.
So we should be investing in insurance companies.
That brings us right back to this.
I think that's
guess,
our biggest
right?
takeaway from this conversation.
You can, but the question, it's stable and consistent. Yeah. But I would argue that over the long run, the more people learn about how insurance companies operate, just the less likely they are to invest in it.
Is this willful blindness again? We had Sam Cooper on talking about willful blindness and the triads and all the...
What is that?
The corruption and the money laundering from
foreign interference.
Foreign interference.
Specifically China.
Especially in the real estate world.
Oh, man, yeah, I can imagine.
Yeah, bringing in drug money, cash.
And politics.
Well, look at what happened with TD recently, right? They were fined for massive laundering. You know, when people sell big policies who do what I do, they have like FinTrack forms and whatnot. Like everyone cares about laundering, but no one really cares about laundering. That's the way I see it. You know?
Well, when it's your commission check or not,
yeah,
then how much do you care?
Just enough to check the boxes, right?
Yeah.
You know, as long as you do, as long as you're compliant, or as long as you ask the questions, you know, and they provide the answers, as long as you believe the money's coming from a safe place, then yeah. But it's hard to say, you know.
Yeah. Okay.
It's hard to say.
Okay, so just getting back to the health spending and the benefits. So if I'm a business owner, like, yeah, I guess I got to sit down and do the math, right? And with the health spending accounts, is it your contention that it's actually better for the business owner?
100%, but it's worse for the employee. And that's the friction, right? Because if you're an employee, let's go back to the grocery store example. If I gave someone, now people understand groceries, so it's a little bit different. But if I gave an employee a $500 gift card to Longo's, and attached to that gift card, I gave them a booklet of everything they could buy in Longo's, right? And put it down on the table. They'd be like, oh, wow, that's amazing, right? And then next to them is just a $500 Visa gift card, right? Now, most people would be like, I'll take the Visa gift card. But in the context of benefits, they're like, oh, look at all that stuff that I'm getting. But all the insurance company's doing is they're telling you eligible medical expenses that can be claimed against the plan. And people look at that like abundance. And it kind of is, right? Because the employer is only giving the insurance company, let's say, you know, $1,000 a month, but your employees have the ability to claim thousands. I deal with a lot of businesses where they want to move to this model, but they're like, my employees are going to be pissed because, you know, before they could spend $1,000 a person in their family on the dentist, $300 a person on all these medical practices. They have all these things that are covered, and now you're replacing that with $1,500. I'm like, yeah, but it's by design. The insurance company wants to create that friction between you and the employees. They want you to pay into this for 2 years so they get used to it. Because then it's hard, then it's impossible to take it away. And no one can deal with, you know, these renewals are 10, 20, 30%. It's impossible to deal with. But the insurance companies love it. And it's not, the insurance companies have to drive up the premium, because if you're selling a product, you just can't make the same percentage off of the product every year if the product doesn't go up in price. You need to make more money. You have to increase the price of the product and ideally keep your margins the same. If your margins are only 15%, the way you make more money is by inflating the product. Insurance companies are effectively inflating the product. They're not inflating the product. They're basically saying to your staff, go spend thousands, we're collecting hundreds. And then at the end of the year, they throw up their hands in the air and be like, oh, Jim, look at what your employees are using. I'm so sorry. How do we fix this? And the fix is stop doing it. You know, just give them a spending limit. But it's hard to do. It's hard to kind of change people's mindset around it.
You'd be a good counselor. Just stop it.
It's the philosophy between the Fortune or Fiction book, to bring it back to this, and the health spending account that I built, Kubono, it's effectively one and the same. I think it's important to realize that these insurance companies, banks, financial institutions, they're not there to help you. They're not there to necessarily hurt you, right? They have an incentive. Understand what their incentive model is and be informed, and then attack it and deal with it accordingly. They're called products for a reason, because they're designed to make someone else money. And don't sit down with someone who's just trying to push you products. which is a hard thing to do because everyone needs to make money to put food on the table, But I do have this innate mistrust in these institutions just because I feel like if you are in a position of power and wealth and someone comes to you and needs something, it behooves you to make sure what you're doing makes sense in the context of what their life is. Not just throw things at them because, well, if they don't know any better and it doesn't hurt them, right? Like this life insurance stuff. Well, they're going to get dividends, and if they die, the family gets the money and they can borrow against it, and it's still good money and they're protected. So why not sell as much of it as I possibly can? Like, what's the worst that can happen? And to be honest, not a lot. Like, the bad money decisions that I've made, like, I wish I put that money into participating life insurance, ironically. It would have been a lot safer. Would I have learned less? Of course. But the issue with this sort of stuff is just that it's kind of, I call it a soft scam, whether it's benefits or life insurance. The reason why it's a soft scam is because you don't know you're getting, generally speaking, you don't know you're getting taken advantage of. You actually think you're being helped. And like, you kind of are being helped, right? In the context of benefits, God forbid something happens to your staff member and the insurance company's there to help. God forbid someone dies, the life insurance policy pays out. People confuse the product maturing and working for the function of what these companies are doing for you. And I think it's important to compartmentalize and separate, why groups are doing what they are doing for you.
Have you read this book, Mark? Fortune or Fiction?
No.
Okay.
I just listened to him, and that was enough for me.
Yeah, I don't blame you. I'm going to update it. I'm going to update it,
Yeah. Well, then I will. No, but I got the, I get what you're saying, right? Because when I first heard about the infinite banking, I'm like, this is great. I need to make some more money, and then we're going to do this because then I can, but anyways, listening to your explanation, it's like, oh yeah, okay, maybe it's too good to be true. Right?
Yeah.
And, there's a place for it, but I'm not in that place.
It's interesting because a big risk to these PAR policies is the lapses. People canceling policies coming off the books. Because remember, they're predicting what they'll be collecting in premiums, what they're paying out in claims. People stop paying for policies. People cancel policies. Obviously, if you cancel a policy, that premium will no longer come in. Over time, as people get squeezed, as cryptocurrencies eat up a lot of the capital in the world, I do think there's a massive risk for these funds being drawn down, and it's significantly affecting the dividends just because, when you see asset prices going through the roof, when you have debt on your policy and you're paying that out of pocket and you have pool of capital there that you can see that you can put into something else, people cancel their policies all the time. A lot of the people that I meet, that I see who are going big into these products, it's just a matter of time until the policy's coming off the books. But the sad reality is, like, the advisor made the money.
Yeah.
Like, if someone cancels a big policy that I sold 3 or 4 or 5 years down the road, it doesn't affect me. I take over policies all the time that are 3, 4, 5 years in. I make myself the agent of record. It's taken away from the existing advisor. Rarely, if ever, unless it's a new policy that was just sold. If you just sold it and someone else is going to move it to me or cancel it, then you're getting a big chargeback. You got to pay back those commissions. But if that commission chargeback schedule has already passed, you don't care. Let the person move on. Let them cancel it. You already got money.
Oh, interesting. Man. And so just, we should wrap up, but what happens so obviously if you're not paying the premiums, you're not going to get the death benefit, but do you still have the cash value that you can collect?
So think of it like credit on a house, right? You have a certain amount of equity. You have a line of credit. You can decide not to pay that interest and just let the interest accrue. And as long as you have enough runway and or the house continues to go up in value faster than the debt is accruing, then who cares, right? It's the exact same thing with the life insurance policy. It's just a matter of managing the debt accordingly. If there's enough value there where you can stop paying the premiums and it can be borrowed against the policy to keep going forever, why not? But if there's not enough value being grown there, then eventually you're going to hit a crossover point where like the debt is too much of the policy and you have to either A, make payments, or if you can't afford to make payments, the insurance company collapses it, gives you the difference back, and it's done. No different than you can't pay your mortgage. You know, the bank's going to sell it.
Yeah.
And whatever's left over, they'll just give you the difference and you're on your way.
Yeah,
you know, so
okay.
it's the same as, and that's my argument. It's the same as any other leveraged financial product. It's a line of credit against an insurance policy. A mortgage is credit against your house. Car loan is credit against your car. It's all credit. And what the pitch gets right is that you should ideally finance everything that you can without having to sell something. Like you're a real estate investor. Mm-hmm. If you needed to buy something, you don't want to have to sell one of your houses to go buy something that you need, right? You want to ideally borrow to keep the asset in place. That's what the principle gets right. And that's why it's so appealing, especially to real estate investors, because that speaks to them.
Yeah.
But the problem is, you know, just because something is so great doesn't necessarily mean you need to go all in on it, especially when there are all these risk factors. And my prediction is, in the long run, these products will not be able to pay a dividend, or the vast majority of it.
When you say the long run, like what timeline is that?
20, 30,
20,
40,
30 years?
50 years, maybe sooner. Like I think, listen, nothing lasts forever. You know, look at ancient Rome with the denarius. You know, in the early parts.
Oh, Rome came
We
up
always
again.
have to have one reference to Rome.
Early on, what the denarius was what basically pure silver, 95% silver, and then by the end it was 5% silver. You know, nothing lasts forever. We're going down that path. We're going to keep adding debt. My dad always talks about, oh, what if interest rates go back to what they were in the 80s, 18? I'm like, the world would implode. Like, you can't have that. Interest rates didn't even get that high, and look how bad things got.
Yeah.
And things didn't even get that bad, but they don't want things to get worse. I'm of the belief that in the long run, we're going to start seeing, you know, basis points drops or increases in interest rates. You know, why 25 basis points at a time? Why not 10 or 5 at a time? You know, I think interest rates are going to drop into slight negative territory as well.
Like higher volatility, so higher rate moves, and then more frequency too.
I think so. Yeah. Like everything we're doing economically is made up. Yeah. Like we're making it up as we go. I can't remember what show it was, but around the 2008 financial collapse, I think it was, I'm going to get the name wrong, but I think it was Ben Bernanke was talking with Bush and basically said, because he wrote and read a lot about the Great Depression. And the Great Depression was very much an issue with, of course, leverage and debt, but liquidity. You needed to get liquidity out to people quickly. And apparently when they were deciding whether or not they wanted to bail out the banks, he basically said, you know, I think you should bail out the banks for this reason. And Bush basically said, well, what if I don't? And he says, well, breadlines in 2 weeks, after that, I don't know. And then Bush was like, okay, like how many billions do you need? You mean to tell me in this day and age, between 100 billion or I don't know, our leaders aren't going to choose pumping 100 million, pumping 200 million. They're going to keep doing this until everything fails, and they have no choice but to do it. You know, debt to GDP ratios, like Japan's on like 3 times debt to GDP. Who says the US or Canada can't be 10 times debt to GDP? I don't know like what the end game is, but I do know that the end game is, I feel like real assets are just going to keep inflating in price. The value of your dollar is going to keep going down. They're going to screw with inflation by telling you the consumer price index is 2%, but your money's being devalued at 8%. All these people are going to be wealthy. The government's going to be like, oh my God, all these people are wealthy. We need to tax them more. And we're going to continue down this path until like, I don't know. And the I don't know is, I can tell you right now that penny wheat stock that you got is going to be no more or less risky than your bond or your GIC, because we're all on shaky financial ground. Yeah. So just understand what's happening, make hay while the sun shines, because you're not going to change the world, you know?
Well, that's
I thought I was going to hear Bitcoin in that rant at the end. Yeah.
Listen, I personally love Bitcoin. I love the concept.
We have time if you have time.
I have time.
Yeah. So what do you like about Bitcoin? Because I'm always curious to get people's thoughts. I love talking to bankers when they call, and like, you know, so do you have Bitcoin? And then it's always different reactions. So.
Yeah. Decentralized. peer-to-peer, right? The value is based on energy. It is a pure investment. It's pure speculation. There's no utility to it above and beyond energy.
When you say the value is based on energy, like energy's in the real world, it has a real cost to it. It's not something like the dollar's based on not energy. It's based on whatever.
Well, actually, the Canadian dollar is effectively based on our ability to make money and spend. Right? When you think about it, like how productive we are. I'm not super into the Bitcoin theoretically, right? I got lucky early because I was hacked and I bought it to pay off the hackers. And then I put a bunch of money in and I've been hodling it ever since. And only I think over the last year have I gone down the rabbit.
You did pay off hackers?
Yeah.
Oh, shoot. I got
Bitcoin was $500 at the time and Ethereum was $11. And that's when I put half my money into Bitcoin and half into Ethereum, and it did very well. But only in the last year have I really gone down that whole, let's say, Michael Saylor rabbit hole of the thought process in and around it. And I remember I was watching a video ages ago where Milton Friedman was talking about a future money network where people can move money across oceans between countries at an agreed upon value without the government's say. And I think that personally, that idea will save the world, because we don't know what the real value transfer is because someone is too easily screwing with it. And at the end of the day, as long as I can transfer value between us and you're getting fair value for the service that I'm providing and vice versa, that's what the economy is based on. And then if you screw up or if I screw up, we need to go back and make a deal. But what can't happen is someone else comes in saying, we're just going to create more of it and bail you both out, and you made a mistake and you won't do it again and we trust you. Because that's really what's effectively been happening.
It's I don't know if you follow financial markets or whatever, but China is now issuing U.S. bonds, U.S. dollar bonds.
Really?
Yeah,
they're issuing
through Riyadh. Well, because they have so many U.S. dollars.
Interesting.
And they're doing this through Riyadh in Saudi Arabia. It's just mind blowing. There's really nothing the states can do because they have so.
Have you heard about the $1 trillion coin that they were talking about?
Yeah, I don't know about that, but they're just issuing bonds saying, "Hey, we're going to pay you X amount. It's in U.S. dollars, and we have U.S. dollars. And when we pay you back, maybe we'll pay you in U.S. dollars, maybe we'll pay you in yuan or whatever." But it's just whoa, that's incredible.
It's not stopping. Look what happened with Silicon Valley Bank in the U.S.
Oh, right? There's a whole other
and I see these.
that.
Well, it's not a conspiracy to say that if they didn't do it, it would have been a massive dent in the U.S. economy. And the argument is, well, all these people who banked with Silicon Valley Bank, right? All these companies find it's their responsibility to underwrite and be careful where they put the cash. But all these employees, all these staff members, all these people who depend on the company, they didn't choose where that money was held, right? Why should all these innocent people suffer because this bank didn't do a good job with their money? So let's just bail them all out. And I get that argument, but we're piling bad on good. And I think to myself, what's the point of, I see these commercials for the CDIC now. I'm first of all, why do you have commercials, right? Why? Why does Ontario have commercials for that matter? Stop. You shouldn't be allowed to spend my money like this. And if you're just gonna,
it's not your money.
I know. If you're just gonna bail everyone out anyways, just do it. You don't need to tell us you're going to do it for years. Just do it. And the idea that there are limits on your deposits right now, they're effectively, the government's insuring everything. And when I hear this stuff and I hear wealthy people talk about Bitcoin being a store of value, and I see them saying, well, it's basically digital gold, and I see Bitcoin being a tenth of the market cap of gold, the way I look at, even if I know nothing about the fundamentals of Bitcoin, which I do know very little, I'm learning more and more, I'm it's an easy 10x from here. Why would I put my money in anything else? If the governments are going to start buying it, if governments have already bought it, if wealthy people are storing their wealth in it, if I can get in and out of it at any time, if I can move it offline and leave and take all my money and go anywhere I want, right? Why not put extra money into it? I believe it's an easy 10x from here over the next 10 years. That's what I personally believe. After that, I really don't know. I really don't know.
So just on the Silicon Valley Bank thing, I don't know if you know Nick Carter. You've heard of him.
Nick Carter?
Follow him on Twitter. He's a Bitcoin guy.
Oh, I thought you meant like the singer.
Yeah. Are you into boy bands? That's our one of the questions we ask every
Maybe
guest.
he's a Bitcoiner. You
What's
never
your
know.
favorite boy band? No, he's got a theory, and it seemed really crazy at first, and now it doesn't seem so crazy, called Operation Choke Point. And that's the U.S. government forced Silicon Valley, SVB, and a couple others who were involved in crypto, basically caused them to close, and that the fundamentals actually weren't that bad, and it did need to happen. And it's because of their hate for crypto and the potential disruption to the U.S. dollar. So, Operation Choke Point, you can Google it or look at it on X if you want to dive down that rabbit hole.
After COVID, I'm willing to consider anything, no matter how crazy it is. Like, I'm not going to listen to anything and like write it off at all. If you're telling me like the Earth
listen to our podcast.
Yeah,
that sounds pretty good.
If you're telling me the Earth is flat and they never landed on the moon, then I'm going to be like, okay, like I think that's a little bit like out of line. But anything else in terms of like economics and money, look at what, the Biden administration was doing in the context of Facebook and trying to control the narrative. Like the idea that people in power don't conspire to reinforce their own existence, whether in an honest way because they believe they're doing it for the right reasons for everybody, or because they're trying to enrich themselves. Of course, like both happen. I find it incredible. I always go back and forth between Fox News and CNN. And CNN is talking a lot about, at least a few days ago right now, about how the conflict of interest between, Musk and Trump, and how Musk has all these government contracts in the context of SpaceX. Meanwhile, look at all these Democratic senators for years that were making, look, Pelosi, never made more than $175,000. She's worth $200 million.
Yeah.
Meanwhile, Elon Musk has effectively dropped the cost of sending things into space by a factor of 10, right, through SpaceX, and it's saving NASA, 90 cents on the dollar to put things up there. But now suddenly it's a conflict of interest.
Yeah.
There's always people in power who feel like if only they were in control, things would be a little bit better. And those are always the people I'm afraid of. And listen, I don't want to say I'm not pro or anti anybody. I just think the system is fundamentally broken because the people in power have too much control over the way we transfer value. And if someone else has control over the way we transfer value, then it's too easy for the system to be screwed with. And I remember the Sam Bankman-Fried stuff with his cryptocurrency. And I remember at that time, people were saying, oh, this is why crypto is terrible. And I'm actually proved why fiat's terrible. Because the reason why it came down, if memory serves me correct, is because it was the guy who owns Binance found out that Alameda Research had the majority of FTX tokens on their balance sheet that they were leveraging. And he realized that Sam Bankman-Fried effectively controlled FTX, and then he dumped it. And when he dumped it, the value dropped down, and Alameda Research lost all their money. FTX effectively lost all their money. And people are like, oh, well, crypto's a scam. I'm like, no. When one person controls the supply of money, right, and can create or trade it up, that just goes to show you why fiat has its problems. It's a really interesting situation.
Yeah. Yeah, you're speaking my language, Adam.
I'm glad I asked.
Well, I can't remember who it was, but there was a comedian I saw on social media somewhere, and he's like, I always, when I'm dating someone, I always ask her, like, do you believe in any conspiracy theories? And if she says no, I'm like really? Like none? Like zero? Like, you don't have to believe everything out there, but you don't believe even one. Because it's like, yeah, you got a point. You got to, don't be a Pollyanna.
Hey, listen, early on in COVID, when people were talking about the lab leak theory, it was like, you're nuts.
Yeah.
Like, I was kind of one of those. I had much more faith in the governments than I do right now, But that was like early on, if you said that, you were a nut.
Yeah.
And then now everyone's like, actually, yeah, it's probably probably how it happened. It's pretty legit. And, it makes you kind of question everything, especially when you hear that the governments were trying to control the narrative and tell these social media companies what they can and can't say. And I'm not for you can do what you want with anything at any point in time, no matter how powerful that you were. That also has problems on the one, that's the other extreme. But, the idea that the people who are in power don't conspire to reinforce their own interests, just like, come on. Like, of course they do. And maybe they're doing it because they believe like they're doing the right thing. Like the highway to hell is paved with good intentions, and I genuinely, a lot of people, I have discussions with a lot of different friends and family members about the system, about money, and people think that there are people in power are actually trying to take power away from everybody. And like, I don't believe that for a second. Like, I don't believe people get into politics or try to lead banks or insurance companies or whatever it is because they're like, there's this big trough and I want to take as much as I can from the trough for my own benefit. I think these people get to these positions of power because they're extremely smart, they're extremely driven, they know what they want to do, and they genuinely believe that they're doing good for other people. And they look at what they're doing through the lens of, how can I benefit as many people as possible? But I also think that that's a double-edged sword because, if you are trying to do all this good, like it comes with a sacrifice, no matter who it is in power. And I think Trudeau is a great example of that. The highway to hell is paved with good intentions. He's done tried to do so many good things that it's coming back to bite him, whether it's a lot of money in the system or a lot of immigration or all these handouts. Listen, if you have a lot of money, of course, you should do whatever you want with it. I love how Mackenzie Bezos is basically giving away her money. Warren Buffett giving away all his money. Those are wonderful things to do, but he earned it. It's his, right? When governments try to do it, you create problems because when everyone's like, oh, the government's helping with this. The government's helping. Like, no, the government's not. It's not their money. What they're doing is they're taking from someone else and deploying it to something that they believe in. And you really got to be careful doing that. And I don't think it works anymore. I really don't.
Well, you've got a rosier view of human nature than I do.
Oh, and fair enough, Maybe I just haven't lived long enough,
Is this an ageist
no, sorry.
thing?
No.
I feel like I'm going down the cynical path.
I think he's trying to sell you life insurance right now.
You should try it. Get a big infinite banking policy. I'll quote you for $10,000 a month and see what that looks like.
Oh man. Okay, Adam, this has been great.
Yeah, it's been fun.
More than I expected. Just insurance. How can people find you, get a hold of you if they want to argue with you? NimanFinancialInc.ca. Just search up my name. My website will come up. My email is niman.financial@gmail.com. I still use a Gmail. A Gmail, really?
Yeah. I have adam@kibono.ca. My Gmail's linked to everything, right? So actually, I still have a buddy of mine who gives me the gears for still having a Gmail. He's like, it's not professional. And I'm like, listen, if this is the one unprofessional thing that I do, you should see everything else that I do, right? Like, this is the least unprofessional thing I do in the context of everything else. So niman.financial@gmail.com. Search up my name and my website will come up. You can get in touch with me there. And buy some life insurance,
Yeah.
All right. Yeah.
All right. Thank you so much, Adam. And to our listeners, thanks for hanging out with us. And until next time,
steward your wealth wisely.